Mark, you ready?
Yes, sir.
We're going to turn over to our esteemed guest and speaker tonight, Mr. Martinez, who he killed it in Sandpoint, so he's got some living up to do. But,
I didn't kill anybody, but
it's all yours, Mark. I'll pull up your thing for you.
No, thank you. So I just want to say thanks so much for allowing me to be part of this. You guys, the REI team from KW is awesome. So I had a little appreciation gift for you, but I realized, and I was going to give it to you at the end, but I thought it might be more appropriate at the beginning because you may take use of it during. So I brought you a 6-pack of Silver Mountain IPA brewed here in Idaho.
Is this for Nick?
No, that's for you.
Because Nick's not here, I'm going to take his gift.
So what Nick, which you can do, because this is for Nick.
Okay.
This is your black 1910 black lager. So it's up to you to determine whether or not you disclose that I gave that to you.
I'm sure it'll get used.
We are on camera, so. But you know, Caitlin and Sam have also been awesome. I just want to thank you guys. I couldn't figure out which one of these should go to whom. So one of you gets, and you can decide yourself, one of you gets the Beauty Blonde Bay, and the other one gets Idaho Sexy. So it's up to you to do Idaho Sexy. There you go. That's for you, Caitlin. Thanks so much for you guys. You guys are awesome. I really appreciate the opportunity. I need one volunteer. One volunteer. Who would like to help me? I need one. I promise you I won't embarrass you. I need one volunteer.
There you go.
Well, I think you came up. I think Sarah's hand went up first. I think. Okay, come on up.
All right, let's do this.
So, Sarah, you said your name is Sarah,
Hi,
right?
my name is Sarah.
Okay. So, I have two things for you to do. Okay. One thing is you need to pay attention because at the very end, I'm going to ask you something. Okay. But you have to wait till the end. Okay. But don't worry, it's not going to be like a quiz. You just need to pay attention and observe. So that's the first thing. Second thing you need to do is at the end of the presentation, remind me that I've asked you to do something because otherwise I'll forget. All right. Okay? And so for you doing that, I'm taking you to the movies. There's movie tickets there. 2 tickets and popcorn. All right? Thank you. And Silas, you're awesome. You bring your kid every time. So you're getting a sugar daddy. And your son's getting a sugar babies. So there you go. Thanks a lot. I love participation. Okay, so I'm going to share with you guys a little, what I call almost everything you need to know about mortgages because I've been doing this going on 18 years and every day I still have questions I don't know answers to. So if I deal with this every day for 18 years, there's a lot you're not going to know. So I want to start with any questions.
Mark, it was brought up earlier about people buying houses together that are complete strangers. There might be some challenges with getting a mortgage together, or do they have to get 2 separate mortgages, or?
Nope.
Nope.
Nope. They would apply equally on that mortgage loan application, and they would both go on title equally. So the only thing you have to remember is they should have an exit strategy. Because if one wants to get married, one of them can't pay the bill, their share of it, you got to have an exit strategy so you know how you're going to deal with that. So that's what I would recommend. So the reason I start out with any questions is because I believe that whenever I have a conversation with somebody who needs me, I always start with what kind of pressing questions do you have in your mind? Because sometimes you think, oh, I want to remember to ask them this. I want to remember to ask them this. And so they're focusing on remembering the question or questions they wanted to ask. And they can't focus in on whatever the discussion is. So that's why I want to start with questions. John, because you went first and you asked a question, score. Any other questions? I may answer them during the presentation. Anybody else have any pressing questions? Yes.
Are you going to be going into any reverse mortgage strategy?
I hadn't planned on doing it, but that's an excellent question. If you can remind me if I forget later on, reverse can be a great strategy for seniors. Yes?
Why would I choose one standard mortgage lender over another?
Great question. I'm not going to address it here, but I will, if you can remind me afterwards, I will, okay? Key things, of course, experience, products, I'm a believer that there's three things that every customer that's looking for a mortgage wants, and this is I tell everybody. Number one is they don't want to be screwed. They don't want to be taken advantage of. And so everybody, if you can make them understand that you're out for their own well-being and what's best for them, you have an opportunity to win that. So the second thing I believe they want is they want to have options, and they want to have their options explained to them so that they can make good decisions. Every applicant does have options in the process, and if they don't realize that they have them, or they're not presented with those options, they're going to have to just go with whatever's presented to them. And so I believe if you can help somebody understand what their options are and guide them into making the best decision, they're going to feel good about the decisions that they make. Because what happens when you feel good about the decisions that you make? You feel great about your experience, and you tell your friends, your family, your neighbors, and your coworkers, right? And that's what we live for. We live for that referral business. What happens when you don't feel good about your experience? You tell your friends, your family, your neighbors, your coworkers, and you post a negative review online.
Usually you tell more people.
Yeah, because you can't hide from your reputation because of the internet. You can't hide from it anymore, right? So and then the third thing I think they look for is they want to be able to get in touch with their lender whenever they have questions. Because a lot of people, they work Monday through Friday, typically, and so they can't maybe make calls or have conversations during the week or during the workday. So if they have questions at night or they have questions on weekends, they typically want to be able to get in touch with them. We pretty much all have a lot of the same products with what I'm going to share today. Blake and Jessica have you guys knocked my socks off in your presentation with the way you guys came up with creative ways to finance. None of those are in here. So this is all traditional financing. If you want creative financing, you got to check out their recording, because they had some amazing ideas, and you guys, my hat's off to you for that. So you guys did a great job. So okay, so we'll dig into this. I'm kind of a believer, if you came out tonight and somebody was asked to speak, you kind of have to know who they are and what they're about to determine what they're, kind of what qualifies them to stand in front and address a crowd. So that's me. By the way, that's my cell phone number direct. If any of you want this slide deck, just text it to me, and I'll just text me and give me your name, and I'll text you the slide deck when we're done. Okay. So my family here. This is my wife here. This is my daughter and her family, her two boys here. And that's my youngest daughter. She's 23 years old. She's 20 years old. She'll be 21 next month. She's excited about being an adult and being able to legally drink booze. So, Caitlin, you might want to save one of those beers for her, okay? This is career number 3 for me. My first career was in the tech industry. I managed a Western state territory. I made a pretty big decision in 2002, and I became an ordained pastor. So I married people and I buried people, and sometimes it felt like the same thing on the same day. But I did that. I did that actually for 7 years. But in 2004 is when I ventured into doing residential home loans. And so I'm going on my 18th year doing home loans. Like I said, I know a lot. I've seen a whole lot. But every day I still have questions that I don't know answers to. Okay. That's the deal. Or else you can email me, and you can access my email from my website. Okay. So when it comes to lending, there's your most popular primary lending sources are these 3 areas. Retail banks, I refer to them as corner banks. You see them on every corner. They have branches, etc., and as well as credit unions. That's one source. They typically have their own loans, but they also do Fannie Mae, Freddie Mac, VA loans. Not all of them do VA, but we'll talk about those loans programs as well. So they have their own loans that they'll make in their own portfolio, or maybe they can't sell it onto a secondary market, but they'll keep it and they'll service the loan, meaning they'll send you that statement every month if it's a make sense deal. You have brokers. Brokers align themselves with multiple banks and investors and hedge funds. So what they're able to do is take an application and then shop it around to different people. That's one of the good things. They can shop a deal, especially if it's one that doesn't qualify for traditional financing. The drawback is that they don't control any of the money. They don't control any of the underwriting decision. They have no money of their own. So they're at the mercy of an underwriter, and they don't have much recourse in getting exceptions on things. So that's the difference with a broker. And then you have your direct lenders. Your direct lenders can either be a bank or somebody who has their own lines of credit, they can loan on it and either keep it and service the loan, or else they can sell it into the secondary market. Have any of you had a loan where like it was funded with one company and then you got a letter in the mail that said, oh, we now have your loan, right? That's what's called selling the loan or the note on the secondary market, because that note is an investment vehicle. Just like real estate's an investment vehicle, the promise to repay the money that was borrowed is also an investment vehicle. So banks will sell those to other people. There are other sources. One source is called non-qualified mortgage lenders. They operate outside of the guidelines of your Fannie Mae's and your Freddie Mac's and your VA's and your USDA's, and we're going to talk about those as well. Private money, which as we talked about, Jessica and Blake back there, are examples of people who, hey, we'll loan money. We've got sources of money. We'll make you a loan, and we'll do it on whatever terms you guys agree to. Seller financing, that's one thing as well. Maybe you want to buy something and you ask the seller to provide some financing for them. Maybe the financing for the down payment or of some sort. So you take a private second note on your first loan. That's what's called seller financing. And then off-market sources. I'm going to share with you a resource that's called Scotsman's Guide, which is a great place to find financing for anything. I have a mobile home, I have land, I have whatever. You just put in what your criteria is. It'll tell you which different institutions around the country will offer those. As well as, if you can't find one, you can post a loan profile. This is my scenario. Will anybody take that? And then if anybody has it financing, they'll respond to that. So we're going to give you a lot of resources. Okay, who can tell me what today's interest rate is?
3.25.
What's that?
3.25.
3.25. Anybody else?
You're asking for the prime or a home loan?
15-year? 30-year?
Investor or primary?
Good questions. Good questions. Let's see. Who hasn't got anything yet? Let's see. You asked what kind, right?
Well, I asked what kind of interest rate? The prime rate?
Okay. I'm going to give you this to you, Les. You're getting a big hunk. All right? You're the big hunk. Yeah, there you go. So the answer to that question is, it depends, right? Every person I ever talked to, just about every person I talked to says, I want the lowest interest rate. And to which my response is, well, I've never met anybody that wanted the highest interest rate. I was kind of hoping you would be the first one, but I guess not. I'll keep looking. So everybody wants the best rate, but there are differences in rates, and we're going to talk about that, which is in question number 2. Can anybody tell me what are the 10 things that determine an interest rate?
Credit score.
Okay, who wants to give a stab at doing all 10? Whoa. Who wants to try? Sarah, you want to try?
I feel like I've done a lot of these. Okay.
Oh, okay. We'll go Sarah first, and then you can add in.
Okay. So like the term, how long is the
How long is the loan for?
Yes. Credit score.
Mm-hmm.
Does your debt to income go into that?
Not an interest rate.
Okay. Wait, I feel like I'm suddenly.
You want to call a friend? You want to phone a friend? Go ahead.
Loan to value.
Loan to value.
That's, blanking now.
Do you want to phone a friend?
There you go.
Credit history?
Well, credit score. Credit score. Correct. Okay. The credit history contributes to the credit score.
Down payment.
Down payment. That's actually loan to value. That ties into loan to value. So.
This points paid.
Yes.
Owner occupancy?
Occupancy. Yeah. Are you owner? Is it a second home? Is it an investment property? Correct.
Real property or imaginary property?
No, that's not one. No, not with the kind of stuff that I do. It has to be real property. Yeah.
The prime rate.
No. What controls the interest rate? You guys are halfway there.
Employment?
Nope. That's just a qualifying factor, not an interest rate determinator. The market? Well, I mean, obviously, yeah, the market's going to contribute to that, but it's not one of the factors, yeah. Okay, you guys give?
If
you're a first-time borrower or not?
That could, no, not really. That's really geared towards the loan program that's available if you're a first-time borrower. By the way, if you haven't owned a home in 3 years, you're considered a first-time home buyer. So if you bought a house and then you sold it, or you converted it into a rental, and then you haven't owned, and then you haven't had that for 3 years, then you're considered a first-time home buyer. Yeah. So.
Does what kind of loan determine the interest rate? Like a VA loan versus traditional? Because I know they're different interest rates.
Yes. That's going to definitely determine the interest rate for sure. And then Jessica.
I had a question on that one.
Yeah.
So, if I heard you right, you can be a first-time home buyer again in 3 years. What if you buy it in your own name and all your other properties you bought in like an entity?
Yeah. If you move your properties into an entity. And then you buy one, then you haven't owned it in your name personally for 3 years, then you're considered a first-time home buyer after 3 years. Yeah. Yes.
I had one lender keeping an eye on the bond market, and he said that affected the interest rate, but that was a long time ago.
That is correct. We're going to get into that. So here they are. Here are the 3 things. Number 1 is loan amount, okay? How much are you borrowing? There are different tiers of loan amounts that determine what that interest rate is going to be. So we need to know how much is that loan amount, okay? Second thing is the credit score, which is one of the ones that was stated. Third was loan to value, which is one of the ones as well. Fourth was type of loan. Remember somebody asked what kind of loan is it? Is it an FHA, VA, USDA, etc. 5 was occupancy. Is it a primary residence? Is it a second home, or is it an investment property? 6 is term. How long? 30-year, 25, 20, 15. Typically, you can do loans anywhere from 10 years up to 30 years. We also still do have a 40-year loan out there. The terms aren't great, but they're a lot better than they were, any interest rates were like 15 years ago. Whether or not you're going to impound your property taxes or insurance. If you're going to have your property taxes and insurance, that's going to impact not a lot, but a little bit of what that rate's going to be. I put documentation on there because there are still loan programs out there that are light documentation loan programs. When I say light documentation, you don't have to prove income, okay? Those are called, or you don't have to prove assets. No income or no asset loans are called NINA loans. There are still companies out there that have them. I don't do them, my company doesn't do them, but I know somebody who does, okay? So if you ever are looking for something that's super creative, let me know. I could create a connection. I don't make any money off of that. That's just a favor. And then I'm not responsible for whatever experience you get with those companies.
No income,
No income, no assets. Those are called NINA loans, okay? And what they're looking for, those are typically geared for investors because they want to see what the cash flow is. That's what they're really looking for, is the cash flow. If it cash flows, they're going to be interested in doing that loan. So that's the key thing there. Also, whether or not you're going to want to pay discount points. Has anybody heard of that term discount points before? Okay.
Just paying down points?
Yes, yeah. So discount points just simply means you're paying a percentage of the loan amount in order to buy down the interest rate, and then you have a lower payment for the life of the loan. I'm going to show you an example of that a little bit later on. And then finally, and this is the most important one, is profit, okay? So whenever you hear anything on the news, TV, or reports, oh, well, Freddie Mac just said the current average interest rate is 3.1%. What they're saying is when Freddie Mac is making a loan under the certain characteristics, right? These are the characteristics of that loan, okay? Then the average is at 3.1% on a 30-year loan. That doesn't include the profit for the bank or the lender. The bank or the lender takes their profit based upon the difference that they receive, that 3.1% loan, and what they actually offer to the customer. Does that make sense? So what Freddie Mac and Fannie Mae and USDA and the VA give us all the same rate on their loan. If I had a 30-year loan of $400,000, 760 credit score, 80% loan to value, conventional, primary residence, 30 years, impounding, full documentation, no points, they're going to give it all a 3.1% rate. But the rate you get has the lender profit built into it. There's going to be their profit for them doing the loan and whatever they get from Freddie Mac. Does that make sense? So you'll see a little bit about that in just a bit. So let's talk about interest rates. Here's where they've been. For those of you who can't see in the back, January of 2020 is where we were at. Okay, And each month through since January 2020 until we hit the December, January 2021, this is where we bottomed out on interest rates. So did any of you buy or refinance in December 2020, January 2021? Yeah. Killer! Congratulate yourselves. Winner, winner, right? Way to go. You guys rocked it, because that's the best it's ever been, okay? They climbed up. Sometimes they climb up steep, okay? And then they move. They constantly move. So anytime you hear on the radio or TV, interest rates are falling, call quick. They're talking about this down part. They're not talking about this up part. They'll get back up here. Interest rates are falling. Interest rates are falling. They don't say anything about going back up, because nobody says, hey, interest rates are getting higher, you should call right now. They always talk about interest rates are falling, right? Because nobody wants to buy that. So this is about where we're at right here nowadays, okay? Here's historical perspective. 2016, 2017, 2018, 2019, this is where we were. 2020, you can see the end of 2020, we were at the bottom, which is where we started 2021, and now they're starting to move back up. This is about where we're at right now, okay? What's interesting is that home prices aren't really affected by rises in interest rates. A lot of people think, oh, when interest rates go up, home prices are going to come down because rates are going up. Well, check this out. Interest rates went up during this time period in 2005. Home prices still went up 13.2%. We're going to block out this housing crash right here of 2007 through 2010-ish or so, because everything was the way it was. But you can see here, we had a rise in interest rates. Home prices still appreciated 7.3%, 9.6%. We had another bump upwards here in 2015. Home prices still went up. So this blue chart represents appreciation in home values, and regardless of what happened with interest rates, home prices were still going up. So Tyler said, when's the best time to buy a house? And what was the answer? 10 years ago. You pay attention. Look, you paid attention.
I did it.
If not, then today, right? Today is when you buy and buy it. Here are the projections for where interest rates are going to go, okay? This is Q1, Q2, Q3, and Q4 of this year. Freddie Mac, Fannie Mae, Mortgage Bankers Association, National Association of Realtors have their own projections on where interest rates are going to go. And then this is the average. Right now, Freddie Mac, 3.1%. I think you actually said that, Sarah, didn't you? Maybe somebody, I don't remember. Yeah, but again, that's based on without the lender profit built in. It's going to go higher, okay? And we're going to see that go higher as well. But I'm telling you, when I bought my first house,
I know.
15?
11.75%. When I, yeah, right? 11.75% when I bought my first house. And guess what? I got called, guess what? We can refinance you for 10.875%. That's awesome! I can't wait! Give it to me now! Right? So, quit your sniveling. Get a house now. Okay? Get a house now. Do what you can. All right? All right, so here are the primary money sources here. Okay? Fannie Mae and Freddie Mac are known as government-sponsored enterprises. They're private companies, but they're backed by the U.S. government, okay? So most people think Fannie Mae and Freddie Mac are government agencies. They're not. They're private companies, okay? Between Fannie Mae and Freddie Mac, FHA and VA and USDA, these five entities, I should say, produce about 83% of all the mortgages in the United States. The other 17% are people like you guys in the back, you guys. People, so you guys do some private money lending, I think if I'm correct, or I don't remember who it was, but that's how other loans are done. So these are either government-backed, or government-secured, or government-issued between these five entities, and we're going to break those down here. First of all, Fannie Mae. Fannie Mae loans and Freddie Mac loans, they kind of compete with each other. They pretty much offer the same rates to us and then we offer to them, but here are some key characteristics. Number one, you can buy a home for only a 3% down payment. A lot of people still think you need a 20% down payment in order to buy a house. You don't. You only need a 3% down payment for Fannie Mae or Freddie Mac loan. But you do pay mortgage insurance. I'm going to talk about that in a second. But the key thing here is there's nowhere else in the world that you can buy a house for 3% down. Nowhere in the world offers something like that. And this is where you're going to get your best rates overall. They also have down payment assistance programs. So if you need assistance, they can put up anywhere from 3 to 5%. The reason of the range is because they can also help with some closing costs. So that's what are known as down payment assistance programs. The state of Idaho actually has those. They're pretty complex. They're really hard to do, and they require a high pain tolerance when you're doing a down payment assistance. You have to be like, and there's a kind of a narrow window of who qualifies. You have to make enough money to make the payments, but not too much money that you don't qualify, that you don't need the assistance. So it's a kind of a tight window. They typically cap at a 45% debt to income ratio. So you take what your gross average monthly income is, whatever your gross income pre-tax, and divide that by or multiply it by 45%, and that's what they'll allow maximum as your housing payment. So your housing payment is going to include your mortgage payment for the loan, your property taxes, your homeowner's insurance. If you need mortgage insurance because you're putting down less than 10%, that goes into it. And then if you happen to live in an area that has homeowners association dues, like condos or townhomes or something, that's all part of your housing expense. So all that housing expense, typically you're going to cap at about 45% of whatever your income is, okay? If you're not a straight W-2 salary person, you get income and the kind of commissions or bonus or rental or whatever, and it varies. We have complex worksheets that will figure out and issue a monthly payment, an average monthly payment for you guys based on your tax returns. They just, starting January 1, the loan limit is $647,200. So that means right here in Kootenai County, you can get a loan of $647,200 on a home. That's the loan amount. So you take that, divide that into 97%, and that's going to be your purchase price that you can have on a loan, okay? Now keep in mind that 3% down is only for a primary residence, okay? And so it has to be your home, okay? But Fannie Mae and Freddie Mac will do second homes, and they will also do investment properties, okay? So I'm going to talk about that in just a minute as well. FHA is another one. FHA requires a 3.5% down payment. They also have down payment assistance programs. They'll go a little bit higher in your debt to income ratios. They'll allow that higher. But they'll also give you better rates if your credit's lower. If you have troubled credit, if you're having trouble with your credit, they'll do a little bit better. They're not as sensitive to a lower credit score than Fannie Mae or Freddie Mac are. The difference also with FHA is mortgage insurance is on the life of the loan. It never goes away. Yeah, it doesn't matter what your loan balance is. Even if you said, hey, I'm going to get an FHA loan and I'm going to put a 50% down payment because my credit's bad, you're still paying mortgage insurance on it.
How much is that typically?
It's typically 0.85. Depends on how much you're putting down, anywhere from 0.8 to 0.85% of the loan amount for the year. So take that loan amount, divide, and that's the annual amount, divide it by 12, that's the monthly payment. So what we do a lot, one of the tricks in our industry, so to speak, is if somebody's struggling to qualify for a conventional loan, but they can qualify for an FHA loan, we'll finance them into the FHA loan just to get into the house. And then once they build some equity, both by appreciation as well as making payments, then we'll refinance them into a conventional loan for long-term and get rid of that mortgage insurance. So that's what I call a two-step process. Step number 1 is home acquisition. Step number 2 is home retention. What do we need to do to acquire the home? And then down the road, what kind of strategy can we put together to retain the home at the lowest cost possible? Make sense? You guys good so far? Yeah. Yeah? Thumbs up? Anybody? Thumbs up? Okay.
FHA, are you only allowed to have one of those at a time?
Yes. FHA is only primary residence. Yeah. It's only primary residence.
If you move and you buy another primary residence, does that other house have to have the FHA taken off of it? Or?
Well, you wouldn't be able to buy, you wouldn't, if you have another FHA loan and you keep that home and turn it into a rental and then you move and you want to get an FHA loan, you have to refinance that FHA loan into conventional. You can only have one FHA loan in your name. And believe me, they find out. They find out. Yeah. Yes?
Yeah, wait, so you can only use this as your primary residence or primary, yeah, your only primary residence, you can only use that for that?
Yeah, you can use it to buy your first home that you're going to live in. You can't use it to buy an investment property or a second home.
Okay.
Yeah.
What if you house hack? You live there.
You house hack? I'm not familiar with that term.
We have roommates.
Yeah.
Oh.
You can do that.
Oh, yeah, yeah. So you can do that. Yeah. But you have to qualify on your own income because FHA won't allow that income that you from the roommates. That's what's referred to as boarder income. You're boarding somebody. So they won't allow that. They won't allow you to use boarder income towards your income calculations. You have to qualify for the FHA loan on your own income. Yeah.
And you only have to be in that property for what, a year? Two years?
To do well. Actually, I should let you finish your question. Go ahead.
If you say you buy it for your primary and you've got in your mind that I'm going to turn this into a rental.
Yeah.
Is there a limit on how long you have to be in that? Or could you 6 months later say, hey, life threw a curveball?
I think you have to intend to live in it for 12
Right.
months. Intend.
Yeah.
Yes. Yeah. That's your declaration. And the reality is, as long as you make your payment, nobody's knocking on your door.
Right.
Nobody knocks on your door. Just make your payment, you know?
Some clients refi after about 90 days. They refi their FHA and they bought another one FHA.
Yeah. You can do that. Yeah, refinance out of the FHA and get into something else. Yes, you can. Like I said, you can only have one FHA loan at a time.
Yeah.
So you can, absolutely. Their limit is $483,000 in the county here. So it's a lower loan limit than we have for the Fannie Mae or the Freddie Mac. Make sense? Okay. Next we're going to go to any military veterans in here? 1, 2, you guys rock. So because of that, I'm going to give you a payday because you rock. Thank you for your service.
Jessica was back there too.
At 100, who? Jessica. Oh, you're military, okay. 100 grand.
Thank you.
Jessica. Jessica, you're awesome. Female serving, you're the king. King size Kit Kat. You are the king. Okay, I'm going to give you guys a tip. If you don't like your candy, at the end of the meeting, hold your candy up and say, anybody want to trade? That's all you got to do. I'm just telling you. Okay. VA, thank you guys for your service. Seriously, that's awesome. And because of your service, you get special entitlement, which is VA loans. VA loan does 100% financing, which is really cool, without any mortgage insurance. There's no mortgage insurance on a VA loan. And you can have multiple VA loans. You can buy one home with the VA loan, then turn that into a rental, move and buy another primary residence using the VA loan without having to refinance that VA loan into a conventional loan, as long as you have enough entitlement. Every military veteran has something called the Certificate of Entitlement, COE is what it's referred to, that tells you how much you're entitled to. So if you're a military veteran, you get me your Certificate of Entitlement. If you don't know where it's at, just give me your DD-214 and I'll get it for you. And if you have an existing loan, I'll tell you how much you can qualify for, and if you want to have a second VA loan. So that's what's pretty cool about VA. They go very high DTIs. We've gone debt to income ratios of 79%. Okay, now here's the question. Why would you want to do that to a military veteran? Why would you want to have 79% of their income on their housing expense? And the reality is because they have other sources of income that just don't count on a loan. So you can have a high debt to income ratio as your income on the loan, knowing there's other income that helps to be able to make that payment. So that's the only reason we would never put somebody in that vulnerability. They would default in payment number 2. If you have really bad credit as a military veteran, we don't care. You still are entitled to really, really good rates, which is good. Their appraisals are very stringent. Okay, so the appraisals are going to really scrutinize the condition of the property as a way to protect the veteran from buying something that's not suitable. So which I think that's kind of cool. And there's almost no limit, no loan limit. I've done VA loans for $1.5 million. You're like, I don't know, you can do that. Yep, 100% financing. You can do. There's almost no loan limit. But again, it's your primary residence also.
Mark, question on the very strict
Yes.
appraisals part, or maybe this is a question for the realtors in here, but is it possible that a seller would say, no VA financing, because they're basically not wanting to fix things, they don't want, they know that their roof is 25 years old, they just don't want to have to deal with that.
Correct. Yeah, there's two reasons sellers will say no VA financing. Number one is because of what you described. They know there are defects that won't pass the appraisal, because if it doesn't pass the appraisal, it's a no-go unless and they can't charge the veteran for it, nor can they increase the purchase price to cover that. So they won't allow that. So that's the first reason. Second reason is that a lot of sellers and a lot of realtors don't know this. So if you're a realtor and you know this, good for you. If you don't know this, then I'm telling you right now. There's two ways to structure a VA loan. One where the seller has to pay for all the closing costs, and a lot of sellers don't like that. And there's another way where the seller doesn't have to pay all the closing costs. It's just a matter of how the loan is structured. So whenever I'm working with a client who's going to use a VA loan, I always engage with their realtor in advance, and I let them know this is how the deal is structured, so you don't have to worry about being kicked to the curb offering a VA loan, because this is what you need the seller and the seller's agent to understand the way the structure. They don't feel like they're giving something up. Make sense? Cool? Yes, Les.
That 100% financing only applies for purchasing and not refinancing.
That also applies to refinancing.
Oh, then I got short into the stick.
Mm-hmm.
You didn't work with Mark?
Is there a business card on that table there? There should be. I put two out. All right, go find it. Okay, last one is USDA. USDA isn't farmland. It is the US Department of Agriculture, but they have their own loans that are available for people like you and me to buy a house, okay? Here's the deal. They will also offer 100% financing, but it's in select regions. It's region-specific, address-specific, okay? And so what's cool about the USDA financing, 100%, but also no mortgage insurance on that, but they also have a very tight qualifying window. And it's based upon how many people are in your household. So if you're a single individual, there's a maximum income that they'll allow, that you can qualify for. If you're a family of 6, you can qualify for way more, because it's based upon how many people are living in your household, which is kind of interesting. USDA loans are really hard, and like I said, you have to have a high pain tolerance. They cap at $388,700 here as a primary residence. I think when Tyler had shown the price points, right, on the MLS price points, not a whole lot of stuff in that price range. But it could be a good source. What's interesting is this right here is our local map of the area here, okay? So we are somewhere around here. I don't know if you can see this outline here. This area is not VA eligible. This outline here, this area is, I said VA, sorry, this area is not USDA eligible, but all these other areas are. Post Falls, Hauser, Rathdrum, all this area here is all eligible for USDA financing. I put my sister's address on here. Sorry, Linda. My sister's over there, Linda. I love her. I'm still afraid of her, though, but I love her. She's... I'm kidding. So she lives right here, right off of Lancaster, just east of 95. She could get a USDA loan on her house. Well, I take that back. $388,700. Yes.
What's the appraisal like for something?
Appraisals aren't as bad as VA, but they're a little bit worse than FHA.
Okay.
Yeah, so they're in that.
Figure for that price point.
Yeah.
Get some rougher homes, unfortunately. I mean, just unfortunately.
Yeah.
Area.
Yeah.
To get a rougher home.
So this website right here, you can type in any address and it'll tell you whether or not you can get a USDA loan on it. Okay, so just type in that website, you can type in an address and it'll tell you, yep, it's USDA eligible, or no, it's not. Okay, just remember, you can buy some, if you don't own a primary residence, you can use these to buy a house, and then however long you live in it, just make the payment, nobody's knocking on the door. You had a question?
What's the actual reasoning for them, the blacked out area, I guess you could say? Is it because majority of the homes are way over 388, or?
Well, the USDA primarily focuses on rural housing, so they determine this.
Property,
Sorry?
like more than just a small city lot type of thing?
Correct, yeah. They consider rural. So they'll usually do up to like 20-acre properties is what USDA will do. So you can see this, can you imagine Post Falls is considered rural? Not anymore, right? They may catch up and rezone their maps, I don't know.
I might have missed, you probably already said it. Is that for primary only?
Primary only, yes, USDA, correct. Okay, so here's my suggestions. Number one, when it comes to financing, have more than one source. I'm only one source, okay? I'm your conventional, straightforward, full documentation, nothing really creative, but you're gonna have your best rates kind of financing guide. That's where I'm at. There's other people in this room who can help in different areas, and that's what the beauty of this group getting together is meeting each other. We don't do all the same things, so ask other people, just be part of a group, okay? Here are some other great resources for you to have, whether you want to take a picture, whether you want to write it down, or text me and I'll send you the slide deck. It's all on there. This is the one where I told you something called Scotsman's Guide. This is what it looks like, the main page. And you can either search for lenders of different types of lending that you want, or you can loan post. You can post a scenario. I am looking for a land/loan lot to purchase, non-owner occupied, in Idaho. I have a credit score. It's about 720. My purchase price is $200,000. I'm going to put down $40,000, and it's going to be between 1 to 5 acres, and I plan to improve it. You can put in these criteria, and it'll say, boom, these are the people that match, and we'll do something like that. Now, they don't always match. This is where you have to do a little bit of your own footwork. You can call them, because some of those banks or lenders or investors will say, oh yeah, and then you discuss your scenario. No, we don't really do that. Well, I told you this is what I was looking for. Oh no, we don't really do that. So you just have to do some footwork on that. That's a good resource there. Here's another resource. If you want to follow what's happening in the mortgage industry, mortgagenewsdaily.com is a great place to go and watch. You'll see there'll be a news stream on all the things that are coming up that will affect the industry. One of the news articles that came up, I don't remember if it was yesterday or this morning, I already forgotten when I read it, is how the Fannie Mae and Freddie Mac are going to start imposing a premium pricing on second homes and investment properties. So they're going to cost a lot more in terms of much higher interest rates. So if you want to move, you want to start making some moves as quick as you can, because they're giving, I think they said they're going to start in June. So they're giving some time for everybody to be able to adjust their what's in their pipelines and stuff before those hit. So go to mortgagenewsdaily.com. You can find it yourself. This is one of my favorite sites. This guy is so funny, Dan Rawich. He runs this thing called Rate Watch. Every day, almost every day, he puts out a 2 to 3 minute summary, not video, but like he speaks over the slides, and he talks about this is the direction rates are going, okay? Somebody said, what are interest rates based on? And they said it's the bond market, right? Who was it that said the bond? Somebody said that. Right, okay. Bill, right? Yep. Okay, Bill said bond, that's correct, okay? I gave away one of my next quizzes. Oh well. So this represents the direction of the bond, okay? When the bond goes down, interest rates get worse. When it goes up, they get better. Bond down, good for rates. Bond up, bad for rates. The bond typically performs inversely to the stock market. Most people are familiar with the stock market. Oh, the stock market had a rally today. Bad if you're looking for a home loan. Oh, the stock market really crashed today. Good for a home loan, okay? So that's your rule of thumb. Stock market good, bummer, I'll wait. Stock market took a dip, great, let's lock that rate, okay? That's kind of a quick thing. And he'll tell you the things that are affecting. In red, non-farm payrolls are going to come, the reports are going to come out better than we thought. It's going to be bad for the bond. Hourly earnings and average work week are going to come out worse than we thought, so it's good for interest rates. Factory orders are coming out as well. They're neutral. We're expecting it, so they're not going to have an impact on these things. This changes throughout the day. So if you ever get an interest rate quoted from somebody like me or conventional financing, and you go back and say, hey, a week later or 2 weeks later, hey, yeah, let's go for that. I don't know, maybe. Depends. It could be, you could have been here, it could have been here. We just don't know. I've had days where as many as 5 times we've had changes to the interest rates. As many as 5 times in one day. So that's how quickly it can move. It's not common that it happens that much, but it can. Okay?
How big are the swings from, if it happened 2 times a day, how big are the swings? 0.00?
Yeah, so it's based on what's called basis points. I'm not going to get into the details on that. I'm actually going to touch on it a little bit later on. But the key thing is you probably won't see a swing more than an eighth to 1/4% on an interest rate in a day. And that's very volatile. So, but it'll make sense when I get into one of these next slides. Okay. All right, quiz number 2. You guys ready for quiz number 2? Mm-hmm. Conventional loan mortgage rates are tied directly to what? The stock market, the bond market, the Federal Reserve, or the prime index?
Bond. Just said bond, right?
Bond, yes, sir. You got it. So you were paying attention. So I'm going to give you, actually I already gave you the answer before that, right? So sorry, you get airheads. Sorry about that, I already gave you the answer. All right, quiz number 4. Nobody, no, I know, but I actually did quiz number 2 twice on purpose to see if anybody caught that. Because if they did, they were going to get like whoppers. But they didn't. Okay, quiz number 4. This is actually really quiz number 4. 3 things which drive interest rates. Which one is not one of them? Employment/jobs, inflation, Federal Reserve, or consumer confidence? Inflation? Employment? Okay, how many people say employment or jobs report does not affect mortgage interest rates? Okay. Okay, how many say inflation does not affect or impact mortgage interest rates? Okay, how many people say the Federal Reserve does not directly impact interest rates? How many say consumer confidence does not directly impact interest rates? Okay, nobody got that right. Federal Reserve is the only one.
No.
The Federal Reserve is the only, most people think, oh, the Federal Reserve just announced. So, we knew that. We always know days in advance of what the Federal Reserve is going to announce. And so the bond market adjusts for it. These are the things. When employment is looking good, oh, the market can bear a higher interest rate. When inflation is up like it is right now, oh, guess what? Prices are higher, so the market can bear a higher interest rate. When people are feeling good about the direction of the economy, oh, they're feeling good about it. They can support paying a higher interest rate. These things all affect the interest rate. Likewise, the opposite. When jobs are down, inflation is like they're really afraid of inflation because they don't think the market can hold it, and consumer confidence is low. That's good for interest rates. Okay, quiz number 5. Who can tell me where home values will go? Will they go? How many think that home values are going to go higher? Okay, how many people think they'll remain steady and kind of? Okay, and then how many think that they'll actually go lower?
What are we talking like?
Home values in general over this next year, okay? All right, so let's take a look at what these stats say. These are the forecasts: Fannie Mae, Freddie Mac, Mortgage Bankers Association, Home Price Expectation Survey, Zelman, and National Association of Realtors. This is what their predictions are for 2022. That home prices, while they're not on the same trend as what they've been in the last 2 to 3 years, they will still appreciate anywhere from 7.4%. The lowest projection is 2.8%, an average of 5% of home price in just this year alone in terms of appreciation. So if you hear somebody say home prices are falling, that's a little bit misleading, because what they're doing is they're saying, oh, these people price their homes up here and now they've had price reductions. Home prices are falling. No, not really. They were just overpriced for the market. But that price that's been reduced to, that it actually sells at, is still higher than and in line with what the trends are. So the whole point there is that everybody's predicting that the home prices will continue to appreciate, just not at the same level as they have. And a home purchased now, January 2021, based upon the expectations of increase, at $350,000 will be worth $461,000 in only 5 years. Okay, that's what the expectations are. And how does it hit home? Any of you guys get this paper? Any of you guys hate getting this paper, but you feel like you just have to get it? I'm in that. Although I love the trivia guy. I do a trivia guy all the time, and I get like 3 out of 5 right every time. I'm really good at trivia. I don't know why I said that. No.
Mark, I live up in the Sandpoint area, so we get a different paper, but it's owned by the same company. There's spelling errors and stuff all the time. Is it the same down here?
Yes.
Every day?
Yes. Yeah. Okay. So December 23rd, 2 days before Christmas, front page article, Idaho growth rate #1 in the nation for the 5th straight year. This report came out from Vantage 2021 population estimates. This was a chart that showed the average growth in the United States and then broke it down by state. You can see it says in the United States, 331 million population, which was an increase of 0.1% population growth. You take out the people that die, you take out the people that are born, and you add all the immigrants, if they count them. It's an average of about 0.1% growth based on their prior year population. Where did Idaho rank? #1. Idaho had the highest population growth of any state. They grew by 2.9% in 1 year. You know what second place is? Utah, 1.7%. That's a huge gap between 2.9 and 1.7. Huge gap, okay? #3, Montana, 1.7, Arizona, 1.4, South Carolina, 1.2, Delaware, 1.2, Texas, 1.1, Florida, 1%, Nevada, 1, South Dakota, 0.9%, okay? Idaho is just exploding, right? So this is why what Tyler said is if you want to buy, you got to get like moving now, okay? Because here's what I read. We talked about earlier, I think Tyler asked the question, anybody have predictions for what's going to happen to real estate? Remember? They asked that? Anything you see in common with most of these top 10 states? Red states. Red states. Let me read to you the bottom 10 states. Michigan, Pennsylvania, Mississippi, West Virginia, North Dakota, Massachusetts, Louisiana, California, Hawaii, Illinois, New York. Anything you see in common here? Blue states. Okay? I'm not making a political statement. I'm just making a political observation. Okay? Tyler had mentioned being in California for 3 days, right? And they're like walking zombies, right? Right? Okay. That's what blue states are. You look at the governors, that's the governance, right? And so what we learned over these last couple of years is I don't have to go to an office every week or every day for work. I'm able to work remotely. So that means if I can work from home, why can't I work from home if I live there or here? So I think that's going to continue to happen. I think you're going to see, these are negative population growths, by the way. 40 down to 50, and they included District of Columbia, which is dead last, negative 2.9%.
What's California,
DC.
Mark? I can't read.
California is negative 0.7%. California lost population. First time in California history they had reduction in population. They're losing 2 congressional seats because of that. So that's going to continue to happen. So people from here that are kind of share values like you and me, probably, I guess. I don't know. I've known some of you. They're going to come to places like this. So the point is, you got to buy. Okay. Rents. Here's price appreciation year over year. 1 year over year. States that are in red grew by more than 20% in just 1 year. In yellow, 15 to 20%. In this darker blue, 10 to 15%. Lighter blue, 5 to 10%. And then 0 to 5% was a very, very light blue. There's 0 states in the union. 0 that only grew by 0 to 5%. Everything grew by 5% or more in terms of housing values, okay? The highest growth was 20% or more. You know what state leads? Number 1, the highest growth in appreciation? Idaho. 37%. 37.1% home appreciation. Okay?
Is this is rent?
Rent appreciation.
No, this is price. This is price appreciation. There's a reason I'm putting this rent here in just a second. This is price appreciation. But see the surrounding areas here, right? They've had pretty significant growth as well. How many of you are renters and are willing to raise your hand and say it? Okay. Does this kind of feel something that might have been in the recent past? Because if not, it will be. It will be. Okay, so here's the beauty, or here's the reality. Rents rise, values rise, and interest rates are rising. That's the trifecta for doom if you're not a homeowner. That's the trifecta. And I can't encourage you more anymore to say, do whatever you can to own a home. Okay? So, let me give you a series of money-saving tips. You guys ready for some money-saving tips? Yeah. Okay, I got 9 of them. I'll try to get through them as quick as I can. Money-saving tips. Number 1, buy your own home. Okay? You can deduct your mortgage interest. You can deduct the property taxes. You can deduct any discount points you pay on your loan. That's deducted from your taxable income. So if you earn whatever, $50,000, $100,000 a year in taxable income, whatever you've paid in interest, property taxes, and if you pay discount points when you close, that gets knocked off of your taxable income. So now you're paying less federal income tax that year, less state income tax that year. Your payment is fixed for 30 years, and that's assuming you have a 30-year loan and you never change it, okay? So unlike rents, which look like this, when you own a home, your payment is like this for 30 years and never changes, right? But guess what? When your payment never changes and you decide to convert that to a rental and then that rents go up like that, that's where you make money. That's where I told the young lady back there, real estate has made more wealth for more people than any other industry in America, real estate. So that's why I love seeing the young people in the room here. You get to enjoy the appreciation, build your own net worth, and if you have to move, you move on your terms. It's not because your landlord is kicking you out. I always say whether you rent or whether you own, you're still buying a home. Right? You're still buying a home.
Somebody else's home.
You're buying somebody else's home for them, right? So that's why you. Now, this house is the house I grew up in. I was born in LA area. I grew up in LA area. Went to college in San Diego State. Lived in Orange County. Moved up here in 2020. This is the house we grew up in. My sister and I grew up in. My mom and dad bought this house in 1975 for $75,000, right? Was it 75, right? Wow. Okay. My mom was freaking out because she's like, how in the heck are we ever going to be able to afford a $425 a month mortgage payment? We can't make it. Because they came from an area, the previous home, their mortgage payment was $90 a month. Okay. They kept that house, by the way, when they bought this one. Good. Okay. So if you take a $425 a month mortgage payment and multiply it by 360 payments, which is a 30-year loan, that means they would have paid $153,000 over the life of the house and the life of the loan, $153,000. That house is worth $1.25 million right now. Now imagine doing that 2 or 3 or 4 or 5 times like some of you investors have done, right? And are continuing to do. Hats off to you guys. Keep it going because that's how you make it. Number 1, buy your own home. Money saving number 2, use other monies to buy that house, okay? You can use your own investments. If you have your own money that are invested in wherever, stocks, bonds, mutual funds, whatever it might be, my question is, are you getting anywhere from 5% to 37% return on that money? Because real estate is. So consider using your own investment money. You're not spending that investment money. All you're doing is you're reallocating it from stocks, bonds, mutual funds, CDs, whatever. You're just reallocating it from that portion of the portfolio to real property portfolio. You're not spending it. You're just retransitioning it so it gets put to work for you. And by the way, if you put, let's just say you put $10,000, well, let's say you put $100,000. Let's say you have $100,000 of your own money that's earning anywhere from 0 to maybe 2% in one of those funds, whatever it might be. Then your earning is based on $100,000. But if you put in $100,000 on a $500,000 home, and you get a 5 to 37% in return, your return, that 5 to 37% is on the $500,000 home, not the $100,000 that you put in. You see that? Make sense? Okay. Most people don't know you can use 401ks and IRAs and other retirement accounts that you may have with your employer for the purpose of purchasing a home. So I help people do that all the time. I just tell them, give me a statement, and then ask them for the terms of withdrawal on that. And some of them, they can take it without tax or penalty, some if they're not retirement age. Other times you can just take a loan against it and you pay yourself. So basically you kind of become the bank. You're paying yourself interest on it. You can get gift funds from family members, fiancés, significant others, that type of thing. You can use that for down payment. If you have cash value life insurance, you can use that. Nonprofits can also give you money. If you have an alignment with a nonprofit, a church or any other nonprofit you work with, that's an allowable form of gift funds. And we talked about seller financing, where the seller finances things. And then you can also get private loans from somebody. So maybe you know somebody says, yeah, I'll put some money up. The reason I put this, shh. You want to pause the camera? No, I'm just kidding. The reason I put that, if you make up a private loan with somebody, I saw your question in the back, I get that. If you have somebody to help you buy a home, just don't tell us about it. Because otherwise you're going to have to document, okay, what are the terms of the loan? How much is it? What's the interest rate? What are the terms of repayment? And that's going to be counted to as your debt to income ratio. Okay, so that's a great way to do it. I think you guys have done that before, right? I don't remember. Yeah, that's a great way to.
Seller financing.
Yeah.
So it's different.
Yes. You had a question in the back, sir.
Yeah, with the 401k and other retirement accounts, if you're going to borrow from those, does that have to be for a primary residence?
Yes.
It does.
Yeah, it can't be for investment properties. Some may allow it for a second home. It all depends. Second homes, by the way, have the same interest rates for the most part as a primary residence. The guideline on that is the second home has to be at least 50 miles away from your primary residence, or it has to be up in a resort community. So if it's less than 50 miles and you live here and then you want to buy another property up in the mountains and wherever, Schweitzer Mountain or whatever, I don't know if they sell homes up there, they probably do, then that's considered, oh, that's a resort community because I like to go away there. So that could be a good case for a second home. Money saving tip number 3. Compare an adjustable rate mortgage to a fixed rate mortgage. Everybody is always real quick to say, hey, I want a 30-year fixed. Okay, everybody's got that. But there's sometimes an adjustable rate mortgage may be a better fit for you. Here are the times. The average life of a loan, most people don't realize, is only 5.6 years before it's paid off. It's not 30 years. And the reason it's 5.6 years is what happens during that time period. They either refinance or they sell it. Right? So I don't know anybody ever that has had a 30-year loan for 30 years. They've either refinanced it or they sold a home. Okay? So if your strategy is going to be less than 30 years, and if you can get a better rate on an adjustable rate mortgage, then why not consider that? Because if it's a lower rate, that means your cost of money is lower, and you're going to wind up refinancing it or selling it anyway. So that's why it's kind of good to know what your strategy is. The indexes are typically low, and the typical time an adjustable rate mortgage might fit best is if you have high FICO scores, a low loan to value, and it's going to be your primary residence. That's where your adjustable rate loans typically are more attractive. The opposite holds true. Usually your fixed rates are going to be better. Okay, but just get a quote. That's all I'm going to tell you. Just get a quote. I haven't given anything away for a while. Anybody here a native Idahoan, born here? 1, 2, 3, 4. You've gotten a candy already. Wait, are you guys also? You 3 in the back, you've gotten a candy. You 3 have not gotten any candy from me yet, right? I think you are due. You guys each earn yourselves your very own Idaho Spud. Thank you guys. Thank you for welcoming us into your beautiful state. Maybe you haven't welcomed us, but I feel welcome. But thank you so much. I love everything the state stands for. I don't want to change anything. I just embrace the culture and everything else it has to offer. So thank you for that. Okay, money saving tip number 4, improve your credit scores. Okay, that's a key thing. There's probably credit scores the biggest influencer on what your interest rate is going to be. Pay down debt. If there's derogatory items in there, challenge them. If you don't have credit, like some of you young people, ask your mom or your dad who has good credit, assuming that they do. Otherwise, don't ask them. If you can be an authorized user on 1 or 2 of their credit card accounts.
Does that affect the authorized user?
It does not.
Wait.
So if you are, let's say, so let me give you an example, okay? My daughter turned 18 years old. I said, you want a cell phone? You get to pay for it now. Okay, great. So we went into the Sprint store, and we'd like to, her phone's in my name, she'd like to get a phone in her name, and the young man behind the counter is like, okay, we need to run a credit report, okay. You just got approved for 5 lines. How did you're 18 years old, how did you get approved for 5 lines? I'm 26 years old, and I can't even get approved for 1 line. Well, I teach a financial literacy class for teens. And one of the things I teach them is the way you build your credit is ask your mom or dad if you can be an authorized user on 1 or more of their credit card accounts that are in good standing. It has to be in good standing. You don't have to give me the credit card. Just put me on as an authorized user, because that credit history on that card immediately gets inherited to that authorized user. So that's what I did with my daughter.
So, but I have a Chase card, and I've been trying to get my husband, like, to have it with me, but they're like, we no longer offer joint accounts, we only do authorized user. But having him as an authorized user still helps his credit.
Will help his credit.
Oh, that's great.
Yep. He doesn't have to get it on his own. Yes.
Something kind of to add to that, they do offer secured credit cards too.
Yes.
Where you put the money down.
Yes.
And then you just pay $500, right? Then you get a $500 limit, and that really helps build people's credits too.
Correct. Yeah. The only thing I don't like about that is you're paying interest on your own money. You have to pay the credit card company on the secured card interest on the own money that you've already deposited with them. So if you can, try to get on your own. Yes.
Yeah. How do you know that your kids are really going to know how to take care of debt? You're almost like giving it to them free and they haven't earned it yet.
Yeah, so that gets them a start. It's up to them to determine what they do. Because even though I taught my daughter financial literacy classes, I taught her all about how to manage credit and keep things, she made some mistakes and now her credit's bad. So that's on her.
Mark said that you don't have to actually give them the card.
Don't give them the card.
Just assign their name.
Yeah.
You don't even know about it.
Yeah, just put them on, just put them as on.
At least 6 months, doesn't it, Mark, to start really making a difference?
I've experienced that, no, it's right away. Yeah, I've experienced that, it's right away.
I don't know, I'd like to see them work for it a bit more.
Yes.
Thinking
No, it's up to you.
I bought a freezer and I got a loan out on that when I first moved out.
Yeah.
Paid for that, or bought some knives and just did that, and just did it on my own.
Got it. Let me time out real quick. Tyler, we're supposed to only be good till 8:30, right?
Yes.
Okay, this is tip number 4. I got 9 tips. So let me blow through them and get the slide deck out. Is that okay? Because did you need time for a wrap up after?
We got lots of beer to drink before we leave.
Well, crack them, right? I hope you kept them out in the snow, haven't you? I should have. Okay, I'm just going to blow through these and figure out how to give away the rest of these candies here. If you have credit card lines, ask them for it to increase the line of credit. So if you have a $1,000 balance and you have a $1,500 credit line, ask them to increase it to $3,000. So, but keep your balance the same. Don't increase your charges. And then don't close any accounts. Don't ever close any accounts unless you have to, or like you got a personal beef with whoever that creditor is. Then go ahead and close it.
Are you referring specifically to lines of credit versus a car payment?
That's correct.
Okay.
That's correct.
What about a HELOC?
Oh no, HELOC. You can pay it off, and you can have a HELOC, and then if you pay it off, or you can keep it. It all depends on what you might need that HELOC for. If you're applying for a new loan and you have a 0 balance on a HELOC, and you have $75,000 line of credit on a HELOC, but it's a 0 balance, when on your new loan application, they're going to hit you for a proposed payment on that HELOC, because they're going to say, hey, you have the capacity to charge up to $75,000, so we're going to hit you with a payment even though you have a 0 balance. So, if you don't know what your credit score is, creditchecktotal.com. Creditchecktotal.com, you can get your all 3 of your FICO scores, TransUnion, Equifax, and Experian, for only $1. It's a credit monitoring service. The $1 gets you 7 days use, and then if you don't cancel it within 7 days, they're going to charge you $30 a month. So go to Credit Check Total, open up an account, pay them $1. You're going to put your credit card on there. You'll download your credit report, and then boom, you'll have your scores, and then you cancel it. And if you want to opt out of credit offers, you're tired of getting them, optoutprescreen.com will opt you out. Okay, money saving tip number 5, seller credit. Here's something that's kind of interesting. Most sellers are like, I'm not going to give you credit, I don't need to. Well, look at this, okay? Seller credit can help you save cash and slightly affects your monthly payment. So here's an example. You purchase something for $400,000, okay? And you want the seller to add a 2% credit. That's 2% of the purchase price. 2% of $400,000 is how much?
$8,000.
I give you the answer there, okay? Nobody deserves candy on that one. So that means, so what you do is just say, okay, let's make this purchase $400,000, $408,000. Give me a 2% seller credit. And by adding $8,000 to the amount, it's only $38 a monthly payment added. So that's $8,000 up front you can have to cover your closing costs, and then it's only an effect of $38 per month on that monthly payment. Okay, so that's an example of how to save some money. Money saving tip number 6. If you're going to know, when you have your loan docs to sign, go into the office to sign them. A lot of places, well, any of us can do what's called a mobile notary. They'll go to you, whatever time, whatever place, whatever day, but they're going to charge anywhere from $150 to $275. If you go into the escrow office or the title office, it can be anywhere from $0 to $50, and that's a way to save some money. Money saving tip number 7. Get a lender credit through a higher interest rate. Okay, this part, this is the real secret where the money is at. So I'm going to try to cover this as quick as possible. If you guys don't get it, then call me and I'll walk you through it if you ever want to do a loan. But this is really where the money's at, okay? So there's something called, whenever we price out a loan scenario, based on your scenario, we always have what's called a par rate. A par rate just simply means you're not paying any discount points to buy down the rate, but you're not getting any credit back either. That's just, it covers our profit and that's it, okay? And when you can choose a rate, you can go in 1/8% increments. As a rate goes higher, your lender credit typically goes higher as well. And the numbers can really vary widely based on the type of loan and all the items in your loan profiles, credit scores, loan to value, everything else. So I'm going to give you an example here, okay? Here's a primary residence, purchase price of $310,000, a 3% down payment, so I just run it out to $300,000, 740 FICO score, first time home buyer. Okay, this is just the example. Whenever I input this criteria into what we call our pricing engine, it gives me my matches here. These are the different loans that we can match, okay? This person can choose an interest rate anywhere from 2.625% up to 5%. So your question would be, why would anybody ever choose 5% if I can get 2.625, right? Okay, well the answer is, how much do you have to pay in order to get 2.625, or how much credit do you get back if you go to 5%? Okay, so these are ranges in 1/8% increments. 3.625 is the closest thing to par rate, meaning that not paying any points to lower the rate or getting credit back. If I go all the way to 2.625%, you're paying 5 points or $15,000 in order to lower that interest rate, okay? And that means you're getting a monthly payment of $1,205. If you go to 5%, you get 3.6% back in lender credit, which is $11,000. So a 2.65 rate, you have to pay $15,000. 5%, you get $11,000 to help you cover your closing costs. $1,205 a month payment, $1,610 a month payment. The par rate, which is closest to 0, is $1,368. That's what most lenders will quote you. Most lenders will quote you the par rate or maybe 1 point, but you have more options available. When I bought my house in April, I chose an above par rate, and I got like $12,000 to help me in closing costs, and I still was at a 3.25% interest rate. Okay? Now here's the deal. And this is the part that takes some time, but I'm going to do it. Ultimately, what you want to look at is, if I buy down, if I pay points, The lower I go in rate, the more I'm paying. It's getting me a lower rate, which is giving me a lower payment, right? Then, if I'm paying $21, $42, $62 a month lower, how much do I have to pay for that? What we do is we divide how much you pay against how much you save, and that's your break-even period right here. So this means it's 69 months you recover paying $1,449 in order to save $21 a month. Okay? If you paid $15,000 to buy down to 2.625, it's going to take you 93 payments before you recapture that $163 a month at a time. Does that make sense? I usually lose people at this point. I'm sorry, but I live in this every day. Likewise, when we go higher in interest rate, how many payments do you have to make before you're paying a higher monthly payment to offset how much you actually got back? Again, what's your strategy? You'll see here 65 months, 56 months, 55 months, 45 months, right? If you plan to get a loan and you know you're going to refinance that out of that or sell a property in less time, take the closing cost credit. That's less money you have to bring into the transaction. It's only going to be a higher payment of anywhere from $21 to $100 or $200, but you're getting that much in closing cost credit. That's money that you're not having to pull out of pocket. And if you're going to pay off that loan from one way or another before that time period, then it's a good money strategy. Does that make sense?
Yes.
Does anybody like I totally get it? That totally makes sense.
I've actually done both sides of it.
Okay. I had a few hands, but I only got one of these, and you haven't got a candy yet, so you get nerds because you understood. You understood. Okay, sorry guys. Going as quick as I can. I apologize, Tyler. Just for reference, and investment properties are the same thing at 3.625. An investment property, same scenario, is 4.125, and it requires a 25% down payment. And what this shows you is if you have a 25% down payment on a conventional loan, you get a slightly better interest rate. But if you do a 25% versus a 3% down payment, it's the same on FHA, VA, or USDA. Okay. Why the range in rates? When I priced this scenario out, Waterstone, US Bank, Fannie Mae, and Wells Fargo all gave me options. 4.125 as an investment property, 25% down is par. US Bank have to pay 1.7 points in order to get the same 4.125, which is about $5,100. Fannie Mae Direct offers 4.375. Wells Fargo offers 4.625 at par. Why that disparity? Anybody remember? Profit. Profit, exactly. How much profit are they going to take? One more thing on that is sometimes the banks or investors, the way they'll discourage a loan that they don't want is they'll charge a higher interest rate. Or if they have too much loan capacity and it's taking them 75 days or so to fund it, and they're like, I can't take any more loans, they're going to charge a higher interest rate. They're going to publish a higher interest rate just so that they don't bring in more loans. Because when I price this out, I'm like, why would I charge a customer 4.625 if I can charge them 4.125? Because whatever I offer, I get paid the same. I get paid the percentage of the loan amount. That's it. So why would I offer anything higher if there's no benefit to me? Well, and even if there was, I'd want the best thing for them as well. So the different reasons why ranged. Money saving tip number 8, ask for a lock confirmation, because when you see that lock, ask them, when you lock the rate, can you send me email me the confirmation? Then ask them what the par pricing is. Then check, because the confirmation will show you, is it 100.126 or whatever. It'll tell you how much money is available for you to come back. Because what we can do here, this is part where I can, if we charge this rate here, where there's $1,350 to come back, to go back as credit, at this tier, at the very first tier, we don't have to give that to you. We can keep that. At this tier, we have to give it all to you. And this tier above, we have to give you all that credit. But at this tier, we don't have to give it to you. The first tier, we don't. And the first tier above par, okay? So that's why you say, hey, did you lock the rate? Yeah, okay, great. Could you send me the confirmation? Sure, no problem. They email you the confirmation. They see that it was locked at 100.450. 100.450 gets $1,350 in credit, lender credit. They may not tell you that because they can keep it legally. They can't keep this legally. Oh, I see. I was locked at just above par. I'm going to get that $1,350 credit, aren't I? Oh, yeah, sure. Money saving tip. Got it? The title of this thing is almost everything you need to know that most lenders won't tell you, right? That's the title of the speech. You guys you feel like you're getting it? Yeah. Okay, good. Money saving number 8. Sorry. Oh, I already did the law confirmation. Number 9, get underwriting approval. If you need a loan, find somebody, because most banks won't do it, who will take your application and completely underwrite it, because the underwriter is the ultimate decision maker. They can say no when everybody else says yes. And if you get your file underwritten ahead of time, then it's like having a suitcase full of digital cash. You're going in and say, we're putting in an offer. We want you to accept this offer. It's already been underwritten. It's already been approved. All we need is an appraisal, purchase agreement, and clear title, and we're ready to close. And if you need more time, if your seller needs more time to move out, you can rent back from me, because I'll be the owner at that point. So you can rent back from me up to 60 days, but it'll get a quick close. Guess what? Sellers agents love that when they've already been underwritten, because it takes out the mystery on whether or not their loan will get approved. And they know it'll be a quick close, and everybody gets paid sooner. Make sense? Whew. Finally, my gift to you guys, if you want, I have Winter 2022 Buyer and Seller Guides, things to consider when buying a home, things to consider when selling your house. And I'll email those to you. If you text me that you want a buyer or a seller or guide or both, I'll email them to you. They're PDFs, they're free of charge. Whew, done. Does anybody fall asleep during this thing? If so, I'm going to give you a turtle. I would fall asleep during it. Okay. Anybody think it was fantastic? Yeah. Okay, who hasn't got a candy? You haven't got a candy. Whopper. Okay. Anybody think it was like mediocre? I'm trying to figure out how to give away a Milk Dud, a Baby Ruth, a Butterfinger, and a Laffy Taffy. Oh well, I'll leave them up there.
You're supposed to ask me something at the end.
Coming up. Thank you. Okay, so I have 2 things here. 2 Waterstone coffee mugs.
All right.
I want you to tell me, based on your observation, which 2 people seem to be more involved and most engaged today. You can't choose yourself, Sarah.
Well, I was going to say John.
John, okay.
I'm very engaged today.
Okay.
Who else? Wait, I don't know. There's a lot of people.
I told you to pay attention and observe, right? Nick? Okay. You guys don't only get a Waterstone coffee mug, but inside each mug is a $20 gift card for my brand new open on Monday favorite place, Coffee Meister on Government Way, just north of Hayden Avenue. There's a gift card for $20 a coffee. So enjoy that. Don't throw the paper away. It's in there. Thanks, guys, very much.